Imagine you are a precious metals supply chain analyst with 25 years of experience. Last Thursday, you witnessed silver hitting a historic high of $121, with investors worldwide queuing up to buy gold and silver bars. 48 hours later, silver prices collapsed 31.4% to $78.53, the largest single-day drop since March 27, 1980. But the most important lesson of your career is this: true opportunities are often hidden within the most violent market turbulence. This crash was no accident. It was the concentrated embodiment of a carefully engineered financial war. What you are about to witness is the complete restructuring of the entire precious metals pricing system. First, look at the most critical data. COMEX registered inventory is down to just 113 million ounces, a 70% drop from its 2020 peak. Sounds like a lot? The problem is the terrifying speed at which it is vanishing. In just 1 week in January, 33.45 million ounces of silver were withdrawn, wiping out a quarter of the inventory in 7 days. At this pace, the entire inventory could be hollowed out in a month. This is not a theoretical concern. This is a reality unfolding right now. Even more outrageous is the data from January 7th. That day, 1,624 contracts demanded delivery of 8.1 million ounces of real silver, and JPMorgan alone assumed 99% of the delivery obligation. This ratio is terrifyingly abnormal. Either other banks have no silver left to deliver, or the entire system is concentrating risk onto a single node. You have to understand how COMEX operates. It functions like fractional reserve banking. There are 445 million ounces on the books, but the registered inventory available to you is only 25%. The remaining 75% is eligible inventory, but the owners have never agreed to delivery. It's like a bank telling you there is money in your account, but you can only withdraw a quarter of it. The deeper issue is that much of this eligible silver isn't even within the United States. A significant portion is stored in vaults in London, Zurich, and elsewhere, making it questionable if it can be shipped to New York in time for emergency delivery. Moreover, as geopolitical tensions intensify, the logistical risks of cross-border metal transport are rising significantly. Now let's talk about the system's darkest secret. For decades, the ratio of paper-silver trading volume to physical inventory once reached a staggering 356 to 1. What does that mean? Behind every ounce of real, existing silver, there are 356 paper promises claiming ownership of it. The only premise sustaining this game is that no one will ever demand turning those paper promises into real silver simultaneously. But now, that assumption is collapsing. Do the simple but terrifying math. If only 10% of current open interest demands physical delivery, that implies a demand of about 50 million ounces. With COMEX registered inventory totaling 113 million ounces, it looks like there's a margin, right? But if this ratio rises to 20%, meaning 1 out of every 5 paper silver investors wants real silver, the entire system collapses instantly. Even more frightening is the alarm sounding from the silver lease market. Normally, lease rates are around 0.3% to 0.5%, but now they have exploded to 8%. An 8% annualized rate means borrowing silver is now more expensive than many people's mortgages. When rates hit this level, it only proves there is no excess silver left in the system to lend. The situation at the London Bullion Market Association, LBMA, is even more suspicious. Historical records show the association falsely reported 3,300 tons of silver inventory in 2021. Although explained as a calculation error, it left a deep scar on the market. By 2025, LBMA's eligible silver inventory had shrunk to only about 155 million ounces, while annual floating demand is between 900 million and 1.2 billion ounces. This supply-demand imbalance is fundamentally unsustainable in the long run. Friday's crash was definitely not market panic, but a technically near-perfect manipulation. When news broke that Kevin Warsh was nominated for Fed chair, experienced large institutions immediately realized this was the perfect excuse to launch an attack. Their operational tactics were precise, like surgery. First, during the low liquidity hours before Asian markets opened, they suddenly dumped a massive volume of futures contracts, triggering a gap down. Then, they placed huge sell orders at key levels, like $90, $85, and $80, to trigger a chain reaction of algorithmic trading and retail stop-loss orders. Most brilliant was the timing. Immediately after the crash, the CME Group raised silver futures margins from 11% to 15%. This seemingly reasonable risk management measure was actually an ultimatum to all leveraged investors: pay up or get liquidated. But here is a detail that sends shivers down the spine. While paper silver prices plunged 40%, global physical silver dealers reported Friday sales volumes reached over 4 times the historical record. This extreme divergence shows that paper silver prices have completely decoupled from real supply and demand. Even stranger is the distribution of trading volume. Of the 180 million ounces of silver futures traded on Friday, most were closed out during the U.S. midday session. This means the manipulators didn't really want to sell silver. They created panic through massive dumping to buy back at the lows. This is a classic washout operation, intended to shake out retail and leveraged investors to prepare for the next big move. From a professional perspective, silver is facing an unprecedented perfect storm. Since 2021, the global silver market has accumulated a deficit of 820 million ounces, equivalent to more than a year's global production vanishing. Even more terrifying is that this shortage is not a cyclical fluctuation, but a structural trend. Why can't mining companies simply increase production? There is a key issue here. About 70% of silver production comes as a byproduct of copper, lead, and zinc mining. Silver production mainly depends on mining decisions for these base metals, not the silver price itself. Even if silver prices double, if copper and lead prices don't rise, silver production will not increase significantly. This creates a supply trap. When silver prices rise, mining companies make more profit, but they cannot mine solely for silver. When silver prices fall, they won't stop mining either because their primary targets are base metals. This supply rigidity is a unique characteristic of silver. Recycled silver supply is also shrinking. When silver was above $100, a large amount of scrap silver did flow back into the market. But after prices fell below $80, the economic incentive for recycling dropped sharply, as recycling involves costs for collection, sorting, and smelting. Especially for small-scale recycling, such as old silver jewelry and silverware, these sources almost completely vanish when prices fall. The grade of major global silver mines is also continuously declining. Over the past decade, the average silver ore grade has dropped from 200 grams per ton to less than 150 grams now. This means extracting the same amount of silver requires processing more ore, significantly increasing costs. Coupled with increasingly strict environmental regulations, the development cycle for new silver mines has extended to 10 to 15 years, making it impossible to keep up with demand growth. Here is the key point most financial analysts ignore. About 50 to 55% of global silver demand comes from industrial uses, mainly solar energy, electronics, automobiles, and electrical equipment. This portion of demand lacks price elasticity almost entirely in the short term. Take a specific example. In solar panel manufacturing, silver paste is a key component for converting sunlight into electricity. Manufacturers cannot reduce silver paste usage to save costs because it would directly lead to a drop in conversion efficiency. A solar panel has a lifespan of 25 to 30 years. If overall performance is compromised to save a few dollars on silver, the loss would be enormous. In electronics manufacturing, silver is used for contact materials, circuit connections, and heat dissipation components. These applications have extremely high reliability requirements, and any substitute material could lead to product failure. Imagine the consequences if a mobile phone suffered circuit connection issues because the manufacturer used inferior substitutes to save on silver costs. The artificial intelligence revolution has created entirely new, rigid demand. Modern AI servers and data centers have extremely strict heat dissipation requirements, and silver is the metal with the best thermal conductivity. A high-end AI server uses 3 times the amount of silver as a traditional server, and once this demand is formed, it is almost irreplaceable. Even more critical is the development of 5G and 6G communication technologies. Silver's application in high-frequency circuits is irreplaceable, and global 5G base station construction is in an explosive period. Each 5G base station requires more than 5 times the amount of silver as a 4G base station. With the development of the Internet of Things, autonomous driving, and smart cities, this demand will only continue to grow. Medical devices are also a significant growth point for silver demand. From antibacterial coatings to precision sensors, silver is increasingly used in medical equipment. Especially after the pandemic, global demand for medical equipment has grown substantially, and this portion of silver demand exhibits obvious, rigid characteristics. When silver prices fell from $121 to $78, those industrial buyers who delayed purchases due to high prices immediately restarted their procurement plans, knowing this price level cannot last. China plays a more critical role in this silver war than most people imagine. As the world's largest silver producer, the Chinese government has reclassified silver as a strategic resource and begun implementing strict export controls. This is not simple trade protectionism, but a carefully designed financial strategy. The brilliance of the strategy lies in the timing. When Western paper silver prices are artificially suppressed below $80, China can acquire physical silver in the international market at extremely low costs. At the same time, by limiting its own silver exports, it further exacerbates global supply tightness. The more the West suppresses paper silver prices through financial means, the more China can obtain strategic resources at cheaper prices. A deeper consideration is currency strategy. China is pushing for the internationalization of the RMB, and precious metal reserves are an important support for currency credibility. When the dollar system faces challenges, nations holding large physical precious metal reserves will gain a greater voice. Russia also plays an important role in this game. As the world's second-largest silver producer, Russia is cooperating increasingly closely with China in the precious metals sector. The two countries are establishing a precious metals trading mechanism that bypasses the Western financial system, which will further weaken Western control over silver pricing. Traditional silver exporters like Mexico and Peru are also beginning to re-examine their resource policies. As the strategic value of silver becomes increasingly prominent, these countries may follow China's lead in implementing stricter controls on silver exports, further intensifying global supply shortages. The most profound change is happening quietly in Asia. Physical silver trading prices in Shanghai, Singapore, and Hong Kong continue to be higher than New York futures prices. When New York COMEX futures prices fell to $78, physical silver prices on the Shanghai Gold Exchange remained stable above $90. This price divergence reflects Asian buyers' fundamental distrust of the Western paper silver pricing mechanism and their independent judgment of silver's real value. The far-reaching impact of this trend is that it could lead to the de-dollarization of the global silver market. Traditionally, no matter where in the world you buy or sell silver, the price references the New York COMEX quote. But now, the Asian market is establishing an independent pricing system based on actual supply and demand. The performance of the Indian market is particularly worth noting. India is not only one of the world's largest silver consumers, but also represents a traditional culture of silver hoarding. When international silver prices plummet, Indian physical demand often sees explosive growth. Supplier friends tell you that Indian buyers entered the market aggressively immediately after prices broke below $80, with buying enthusiasm exceeding even the traditional peak demand of the festival season. Institutional investors in Japan and South Korea are also quietly changing their strategies. In the past, they mainly invested in silver through paper instruments like ETFs, but now more and more are shifting to physical holdings. This change reflects concerns about the stability of the Western financial system and a re-recognition of the wealth preservation function of physical assets. Sovereign wealth funds in the Middle East have also begun allocating heavily to physical silver. These well-capitalized institutional investors don't lack money. They want hard assets that can truly preserve value. When the fiat currency system faces a crisis of confidence, only physical assets can provide a true sense of security. JPMorgan's dominant position in the silver market is well known, and the bank was once fined nearly $1 billion for manipulating precious metals markets. But its current strategy is more complex than outsiders imagine. In the massive delivery on January 7th, JPMorgan bore 99% of the silver delivery obligation. On the surface, this suggests JPMorgan possesses a large silver inventory. But analyzed from another angle, this may expose a more terrifying truth. Other major banks may no longer have enough physical silver to fulfill delivery obligations. There is an important strategic signal hidden here. If JPMorgan were truly actively hoarding silver, why deliver such large quantities when prices are relatively low? A more reasonable explanation is that the bank has anticipated an outbreak of massive physical delivery demand and is clearing inventory in advance to switch to cash settlement when the delivery crisis erupts. The performance of other large banks like Citi and HSBC in the silver market is also suspicious. They hold huge short positions in the futures market, but rarely conduct physical delivery in the spot market. This practice implies they may not have enough physical silver to back their paper positions. Deutsche Bank's situation is even more subtle. As one of Europe's largest precious metals dealers, Deutsche Bank's influence in the silver market cannot be underestimated. But the bank has faced serious financial difficulties in recent years, and the sustainability of its precious metals business is in question. If Deutsche Bank encounters problems in the silver market, it could trigger a chain reaction. The role of central banks is also changing. Traditionally, central banks mainly hold gold as a reserve asset and pay less attention to silver. But with the rise in silver's strategic value, more and more central banks are beginning to consider including silver in official reserves. Once this trend takes shape, it will have a profound impact on the silver market. Now we enter the most critical time window of the entire game. March is a major delivery month for COMEX, where a large number of futures contracts will expire, and holders must decide whether to take physical delivery or settle in cash. Current open interest far exceeds COMEX's deliverable inventory capacity. The silver market is currently in a state of spot premium, backwardation, a clear signal of strong immediate demand and tight supply. Investors are removing registered metal from COMEX inventory at an unprecedented speed. Based on years of experience, when spot premiums continue to widen, liquidity crises often occur in the futures market. If this divergence reaches extreme levels during the March delivery month, COMEX may be forced to declare force majeure and allow cash settlement instead of physical delivery. Historically, similar situations are not without precedent. In April 2020, WTI crude oil futures saw negative prices precisely because of insufficient delivery capacity. Although silver is unlikely to see negative prices, the risk of massive cash settlement is real. Once COMEX begins large-scale cash settlement, the credibility of the paper silver market will suffer a fatal blow. Investors will completely lose trust in paper silver instruments, and the global silver pricing mechanism will face restructuring. This could be the most important structural change in the precious metals market since the collapse of the Bretton Woods system in 1971. Understand the current crisis from a grander historical perspective. In 1980, silver prices plunged from $50 to $10. That crash was mainly due to the bursting of a speculative bubble. The Hunt brothers' plan to corner the silver market failed, leading to a price collapse. But the situation in 2026 is completely different. The driving force this time is not speculative hype, but real industrial demand and structural supply shortages. The 1970s oil crisis offers a more accurate historical analogy. When OPEC began restricting oil exports, the global energy market underwent a fundamental restructuring. Oil prices rose from $3 per barrel to $30, a 900% increase, and this high price level was maintained for a full decade. Silver may be undergoing a similar transformation process, from a general industrial metal to a redefined strategic resource. Once this shift is complete, it is hard to reverse. In this context, $121 might not be the top of this bull market, but the starting point of a new price system. In the current extreme environment, traditional investment strategies need to be thoroughly rethought. The risks of paper silver ETFs and futures contracts have been fully exposed, and the possibility of cash settlement turns these instruments from investments into pure gambling. Mainstream ETFs like iShares Silver Trust claim to be backed by physical assets, but whether they can truly provide physical silver in extreme circumstances remains a question. A deeper investment strategy is to position oneself in key nodes of the entire silver industry chain. Companies with low-cost silver mines and complete smelting capabilities will gain pricing power in a supply-constrained environment. But investors must also be careful to identify assets with real value and avoid those silver mining stocks that are just hype. Geographic location has also become exceptionally important. Silver assets located in politically stable regions with reliable logistics networks and immune to export controls will command a huge geopolitical premium. Conversely, investments overly reliant on supply from a single country or located in geopolitically sensitive areas will face extra risks. For individual investors, strategies for acquiring and storing physical silver also need careful consideration. The liquidity and recognition of silver bars and coins vary greatly across different regions. In some cases, choosing storage services from reputable banks or insurance companies might be safer than self-custody. We are standing at a historical turning point in the precious metals market. The coming weeks will determine the direction of the game and redefine silver's status in the global financial system. If COMEX successfully survives the March delivery crisis, the paper silver system may continue to limp along, but its credibility has suffered irreversible damage. Investor trust in paper silver instruments will be permanently impaired, and the scarcity premium of physical silver will continue to widen. If delivery demand exceeds the system's capacity, we will witness one of the largest price repricing events in financial history. Paper silver prices may completely decouple from physical silver prices, forming a dual market structure. Regardless of the scenario, one basic fact is indisputable. Silver is transforming from an optional industrial raw material into an irreplaceable strategic resource. This transformation is reflected not only in price, but also in the reshuffling of the global political and economic landscape. In this new era, only the physical is real, and only the supply chain determines destiny. Investors who understand the essence of this change and make strategic layouts in advance will be the ultimate beneficiaries of this historic shift. This is not a short-term speculation game, but a long-term bet on changes in the global economic structure over the next decade. The most critical thing is to remain rational and patient. Violent market volatility will continue for a while, but those investors who adhere to long-term value investment principles and focus on physical asset allocation will eventually receive generous returns. This silver revolution has only just begun, and the most exciting part is yet to come. If this in-depth analysis has helped you see the truth of the market, please like to support more exclusive content. Share your views and strategies in the comments section, and let us witness the unfolding of this historic moment together. Remember to subscribe to the channel for continuous professional market insights and analysis.